It wasn't subprime mortgages. It wasn't Lehman Brothers. It wasn't even the housing bubble itself. It was the inevitable mathematical conclusion of a debt supercycle. Most observers look at 2008 as an anomaly, a glitch in the matrix, a failure of regulation. But history suggests a different diagnosis. 2008 was a tremor, a warning shot across the bow of the global financial system. The structural imbalances that caused it were never resolved. They were papered over, transferred from private balance sheets to public ledgers. Now the bill is coming due. The pattern is unmistakable. It appears across empires, centuries, and continents. It follows a rigid sequence. Dominance leads to arrogance. Arrogance leads to overextension. Overextension leads to currency debasement. And debasement leads to social fracture. We are going to examine this mechanism through three specific historical lenses: the Spanish Empire, the Weimar Republic, the British Empire. Then we will map the arithmetic onto the current global economy. The numbers do not care about political narratives. The arithmetic is merciless. Let us begin in the 16th century. The Spanish Empire under King Philip II. The sun never set on his dominion. Ships laden with silver and gold flowed from the Americas into Seville. It looked like infinite wealth, but it was a mirage. The influx of precious metals did not create productive capacity. It created inflation. Prices in Spain skyrocketed by roughly 400% over the century. To finance endless wars in the Netherlands and against the Ottomans, the crown borrowed heavily. They relied on the Fugger and Genoese banking families. The debt piled up. The interest payments consumed the royal revenue. Then came the shock. In 1557, Philip II declared the first sovereign bankruptcy. He converted short-term loans into long-term bonds called juros. It was a default in all but name. Think about what that means for the average citizen. A minor noble in Castile, living on a fixed income, saw the price of bread triple while his pension remained flat. The middle class was hollowed out. The empire began a slow, agonizing slide into irrelevance. Just like the Spanish Empire, Weimar Germany faced a wall of debt it could not scale. The year is 1923. The catalyst was World War I reparations. The industrial heartland of the Ruhr was occupied by the French. Production collapsed. The government chose the path of least resistance. They printed money to pay striking workers. The result is well documented, but often misunderstood. It wasn't just numbers on a page. It was the annihilation of the saver. A university professor who had saved his entire life for a comfortable retirement found that his life savings could not buy a cup of coffee. Stories abound of workers rushing to buy goods immediately after being paid. By the time they reached the back of the line, the price had risen. The currency died. Social order disintegrated. The middle class was radicalized, paving the way for extremism. Just like Weimar Germany, the British Empire found itself crushed under the weight of war debts. Though the unraveling took decades rather than months following to world wars, Britain transformed from the world's creditor into a debtor nation. The pound sterling, once the bedrock of global trade, began a long, painful retreat. The government attempted to maintain its global standing and a growing welfare state simultaneously, a fiscal impossibility that drained the national treasury. By 1931, Britain was forced to abandon the gold standard, severing the link between the currency and hard assets. But the true reckoning arrived later. Throughout the 1960s and 70s, the stop-go economic cycles created persistent instability. The culmination was the 1976 humiliation, where the United Kingdom, formerly the master of the globe, was forced to go hand in hand to the IMF for a bailout. The British workers saw their standard of living stagnate as inflation ate away at wage gains, and the country was beset by strikes and the winter of discontent. The empire didn't explode. It eroded until the money simply didn't work anymore. The pattern repeats in 7 distinct stages. Stage 1 is sound money, where the currency is backed by something tangible and debt is low. Stage 2 is the expansion, where infrastructure is built and society flourishes. Stage 3 is the accumulation of debt, usually driven by geopolitical ambition or social programs. Stage 4 is the crisis, often a war or a financial shock. That makes the debt burden unpayable under normal terms. Stage 5 is the turning point, the monetary shortcut. This is where the currency is debased. Interest rates are suppressed, and the supply of money is expanded to cover the deficit. Stage 6 is the loss of faith, where the public realizes the currency is losing value and flees into hard assets like land, gold, or commodities. Stage 7 is the reset, where the old currency is scrapped or revalued, and a new system is born from the ashes of the old. Just like the British Empire, the modern global economy has moved deep into the later stages of this cycle. Current data suggests we are firmly in the transition between Stage 5 and Stage 6. Global debt has surged to roughly 300% of global GDP. Central banks spent the last decade suppressing interest rates to stimulate growth, encouraging governments and corporations to leverage up to historic levels. Now, as inflation forces rates higher, that debt is becoming toxic. We see this in the fragility of regional banking systems and the ballooning interest payments on sovereign debt. The incentive for policymakers is to keep the system liquid at all costs, which paradoxically ensures that the underlying insolvency is never addressed. There's a common counterargument to this grim outlook. Many economists argue that modern central banks have tools that did not exist in the 16th century or the 1920s. They point to swap lines, quantitative easing, and digital ledgers as mechanisms that can manage these pressures indefinitely. They argue that because debt is denominated in a nation's own currency, technical default is impossible. However, this misses the fundamental reality of purchasing power. While a sovereign nation can indeed print the money to pay its nominal debts, it cannot print the value of that money. The arithmetic is merciless. If the supply of currency expands faster than the supply of goods and services, the value of the currency must fall. The tool of printing money is simply a transfer of wealth from savers and wage earners to the debtors and asset owners. It does not solve the structural imbalance. It merely shifts the pain to the currency itself. The endgame approaches in one of three ways. First is controlled decline, often called financial repression. This occurred in the United States and United Kingdom after World War II, where interest rates were held below the rate of inflation for a decade, effectively liquidating the real value of the war debt at the expense of bondholders. Second is chaotic collapse, similar to the Soviet Union in 1991 or the Weimar example, where the political structure fails alongside the currency, leading to a vacuum of power and rapid, painful reorganization. Third is a managed reset and restructure, akin to the Bretton Woods Agreement of 1944, where global powers convene to establish new rules, peg currencies to a new anchor, and write down unpayable obligations. The only variable is timing and pain. If you want to understand how to navigate these shifts, you must educate yourself on macro-historical cycles and focus on resilience. Rather than speculation, pay attention to the data, not the headlines. Subscribe to continue this investigation into the machinery of the global economy. Would you like me to identify the best visual cues or B-roll ideas for each of these sections?